title of today's post is Managing Business Finances, a step-by-step guide for beginners. Managing business finances is crucial for the success and growth of any company. Whether you are just starting out or have been in business for years, having a solid understanding of your finances is essential. In this step-by-step guide, we will walk you through the process of managing your business finances, from setting up a budget to tracking expenses and analyzing financial statements, so that you can make informed decisions to drive your business forward. Step 1. Set up a budget. The first step in managing your business finances is to create a budget. A budget is a financial plan that outlines your projected income and expenses for a given period. It serves as a roadmap for your business and helps you allocate your resources effectively. Start by gathering all relevant financial information, including sales forecasts, historical financial data, and fixed expenses such as rent and utilities. Next, categorize your expenses into different categories such as payroll, marketing, and overhead costs. Once you have your expenses listed, estimate your projected income. This can be based on your sales forecasts or historical data. Be realistic and conservative when estimating your income to avoid overestimating your revenue. Finally, balance your budget by ensuring that your projected income exceeds your expenses. If your projected expenses are higher than your income, you may need to make adjustments, such as reducing expenses or increasing sales. Step 2. Track your expenses. Tracking your expenses is essential to ensure that you are staying within your budget and to identify areas where you can cut costs. It allows you to see where your money is going and make necessary adjustments to improve your financial position. Consider using accounting software or spreadsheets to record your business expenses. Categorize your expenses into different categories, such as payroll, marketing, and office supplies to make it easier to analyze your spending patterns. Regularly review your expense reports and compare them to your budget. Identify any discrepancies and investigate the reasons behind them. This will help you identify any overspending or potential areas where you can save. Step 3. Manage cash flow. Cash flow management is critical to ensure that you have enough money to cover your expenses and meet your financial obligations. Poor cash flow management can lead to financial difficulties and even business failure. Start by projecting your cash inflows and outflows. Consider factors such as customer payments, supplier payments, and upcoming expenses. This will give you a clear picture of your cash position and help you identify any potential cash flow issues. Next, analyze your cash flow statement regularly. Track your cash inflows and outflows on a monthly basis to spot any trends or patterns. This will allow you to anticipate any cash flow gaps and take necessary actions, such as increasing sales or delaying expenses. Consider implementing strategies to improve your cash flow, such as offering discounts for early payments or negotiating longer payment terms with suppliers. Additionally, consider establishing a cash reserve to help you weather any unexpected cash flow fluctuations. Step 4. Monitor key financial ratios. Financial ratios are valuable tools that allow you to assess your business's financial health and performance. By analyzing these ratios, you can identify areas of strength and weakness and make informed decisions to improve your financial position. Some key financial ratios to monitor include 1. Gross profit margin. This ratio measures profitability after deducting the cost of goods sold. A higher gross profit margin indicates better financial performance. 2. Current ratio. This ratio measures ability to meet short-term obligations. It compares your current assets to your current liabilities. A ratio greater than 1 indicates a healthy financial position. 3. Debt-to-equity ratio. This ratio measures the proportion of debt to equity in your business. A lower ratio indicates a lower risk of financial distress. Monitor these ratios regularly and compare them to industry benchmarks to assess your financial standing. If any ratio deviates significantly from the norm, investigate the reasons behind it and take appropriate actions to improve it. Step 5. Analyze financial statements. Finally, analyzing your financial statements is crucial to gain a comprehensive understanding of your business's financial performance. Financial statements such as the income statement, balance sheet, and cash flow statement provide valuable insights into your business's profitability, liquidity, and financial stability. Start by reviewing your income statement, which summarizes your revenues, expenses, and net income. Look for trends and patterns in your revenue and expenses and identify any areas where you can make improvements. Next, analyze your balance sheet, which provides an overview of your assets, liabilities, and equity. Assess your working capital and determine whether you have enough resources to cover your short-term obligations. Finally, review your cash flow statement to analyze your cash inflows and outflows. Identify any significant changes or patterns and evaluate how they impact your cash position. By regularly analyzing your financial statements, you can identify areas of improvement, make informed decisions, and adjust your financial strategies accordingly. In conclusion, managing business finances is a crucial aspect of running a successful business. By following this step-by-step step-by-step guide in implementing effective financial management practices. You can gain control over your finances, make informed decisions, and drive your business towards long-term success. Remember, effective financial management requires regular monitoring, analysis, and adjustment, so make it a priority in your business operations.